Okay, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James, and on this podcast, we talk about any stock that is on the brink of bankruptcy, looks to be not doing too well, or otherwise is just trading abnormally. Before we get into today's podcast, just a quick disclaimer. Nothing in this podcast or any of the other episodes we put out should be taken as investing advice. It's especially true today. We're going to be talking about a probably especially risky stock that's looks to be flirting with bankruptcy in the not too distant future. So make sure to do your own research and consult an investing professional before making any financial decision. So with that being said, the stock that we're going to be talking about today is called T2 Biosystems. So this is a small biotech company based out of Massachusetts that basically what they do is they create machines that detect sepsis-causing pathogens such as E. coli. So this is the machine that they create. So the first selling point is that it's very rapid. Results are only take about 3 to 5 hours compared to days for other machines that are on the market. The other selling points are that it's very sensitive, so it has very good results and very good accuracy, and it's also simple to use. It doesn't take too much preparation of the samples before it's ready to put into the machine. So this company, as I mentioned, has been around for about 10 years now. The problem is that it's basically a failed business. They don't make enough money to cover their costs. And you can see that in the share price over the course of the past 10 years. Since they went public, adjusting for stock splits, their share price has gone down from over $1,000 to just recently under 10 cents. Reason for that is they're basically running out of cash. Their business just doesn't work. They don't make enough money, and they're going to go bankrupt at some point and then in the near future. Interestingly, though, as they've gotten closer and closer to bankruptcy, they've done several equity raises, and in the past year, their share count has increased by 50-fold. And inexplicably, in the past 6 months, their share price has also increased massively by an order of magnitude from less than 10 cents to just about 60 cents just a few weeks ago, and it remains elevated. So with bankruptcy on the horizon and their share count already being diluted massively, and the company themselves has said that they're probably going to go bankrupt, the massive increase in share price is confusing to say the least. So I'll kick it over to you, James, if you want to explain what is going on with this stock.
Yeah, so I think first off, we can delve a little deeper into the financial performance of the company historically and see why this business has failed in the first place. So, um, their first machine gained FDA approval in 2014, and that's also when they IPO'd. So people were very excited around that time. They just got their machine approved, and they were making it out like this is some revolutionary new machine that's going to save a lot of lives by being able to test for E. coli in the lake very rapidly. And their revenue did increase somewhat in the first few years, but this company has never turned a profit. Not only have they never turned a profit, they've never turned a gross profit. Their gross profit here in orange has always been negative. This means that it costs them more to make the machine than what they can sell it for. And they've also sold very few of them. I think in their entire history, they've only sold about 180 machines. And that goes to show that this machine probably really isn't so good as they're making it out to be, or maybe there's some other problems with it. But historically, hospitals have just been very reluctant to buy them. So they've only been able to sell them at a price that is lower than their cost. So they have always been losing money. So 2014, they released their first machine. In 2018, they they got approval for their second machine, which is basically the same as the first machine, except it tests for different pathogens. Um, and then here you see a massive surge in revenue in 2020 and 2021, but this is purely because this was during COVID, and they developed a COVID testing machine. which saw a massive surge in sales. But again, they were losing money on it, selling it for less than it cost them to make it. And and as COVID has gone away, that COVID testing revenue has also dried up. And we can see that here if we look at the quarterly chart of their financials. When COVID hit, they released their COVID testing machine, big surge in sales. Then, kind of by 2023, there's no more demand for these COVID machines, and the revenue goes back down to what it was before, and they're losing money through this entire time. Now, they raised a bunch of money from their IPO. So at the time of the IPO, they had about $70 million worth of cash. Now, over time, they have only ever lost money, but they've continued to do equity raises over time. And whenever their cash balance goes down, they do another equity raise, dilute shareholders more, and keep themselves afloat. Now, if you look at the share price, back when the share price was at $1,000, this is all adjusted for stock splits, it was easy for them to raise a lot of capital by issuing new shares. But over time, as the business has sort of been floundering and they have been completely unable to ever turn a profit, the share price has understandably declined. And as the share price has declined, it's become more and more difficult for them to raise enough money to stay afloat. And so by the end of 2022, they were in a pretty desperate situation. They only had $10 million of cash in the bank. And this is a company that burns $12 million per quarter. So they had one more quarter left of cash. And the share price by this point was already very low. So they were extremely desperate. So they did an equity raise. So at the end of 2022, they had 8 million shares outstanding. They did an equity raise in the first quarter, which gave them $12 million of cash. And their share count went from 8 million up to 20 million. But as part of that equity raise, they also issued a ton of warrants. And in the second, which can convert into equity at a certain strike price. And in the second quarter, the share price increased and all of those warrants were redeemed and executed, and their share count surged to $240 million. And then subsequent to the end of the second quarter, so on July 4th, they did another equity raise. Well, it wasn't exactly an equity raise. They have $50 million of debt outstanding, and they negotiated a deal with one of their creditors to convert $10 million of that debt into equity. And that translates equity plus warrants, and that translates to another $140 million worth of shares. So if you look at this, it's a 49 times increase in the share count between the end of 2022 and as of July 4th, 2023. They increased their share counts by 50 times, which means they diluted the existing shareholders by 98%. And for all of that, all they got was $12 million of cash, and they reduced their amount of debt by $10 million. And this is a company that burns $12 million of cash per quarter. So they diluted by 98% and only got 1 quarter left. One more quarter worth of cash. So this is truly a sign of a desperate company when you have to issue so many shares and they're still going to run out of cash. As of the end of the second quarter, they had $16 million of cash and they burned $12 million a quarter. So they really are on the brink of bankruptcy. And when you go back to the stock chart, this was sort of well understood by the market, and the share price was going down basically to zero. It got down to as low as 7 cents. And then just in the past few months, you see this massive surge in share count. And so back here, this was like a penny stock worth maybe like $10 or $20 million. And then they massively increase the share count, and inexplicably the share price increases. So now they have a $100 million market cap. Although if you adjust for the warrants they issued prior to the end of the second quarter, it's actually about a $115 million market cap. So what is going on? This company is still going to go bankrupt within the next 1 or 2 quarters unless they do another equity raise. And even if they do another equity raise, that's just going to buy them a little bit of time. They've been operating since 2014 and have never made a profit. Why would that? Why would that ever change? So, what can explain this massive rise in the share price? So, I looked on Twitter and I looked up TTO, which is the ticker symbol short squeeze. And it appears like there's a lot of people on Twitter talking about a short squeeze. See short squeeze alert, TTOO. Yeah, see short squeeze, TTOO. Movement is typical of a short squeeze. People are still hyped on TTO. So it does appear like this rise in share price has primarily been driven by retail investors who think that there's going to be a short squeeze. Now, the chances of there being a short squeeze are extremely unlikely. According to marketbeat.com, the most recent short interest data is $16 million short, albeit this data is delayed. This is from August 15th. Now, the reason a short squeeze is probably unlikely is because the share count has been increasing so massively. So a short squeeze happens when there's a lot of short sellers and a limited number of shares available that they can buy. And then as the price of the stock increases, these short sellers get margin called and are forced to buy a bunch of stock, pushing up the price. But if at the same time the company is massively diluting shareholders and massively issuing more shares that will get sold onto the market, well, that'll create a massive supply of new shares for the short sellers to buy and cover their positions. So a company that is increasing its share count so rapidly is generally not a candidate for a short squeeze. The only other reason that could possibly explain the rise in the share price is that people are talking about FDA approval, and they think that's some major catalyst. So they have two machines that have already been released. This machine was approved in 2014. This machine was approved in 2018, and they've both been commercial failures. And they also have a third machine, which is currently undergoing US clinical trials, and it could receive FDA approval sometime within the near future. However, this third machine, it's the same as the first two machines, except for it tests for different pathogens. So it's pretty much the same thing as the previous two machines, which have both been total flops. Why would you think that the third machine would be any better? And even if this machine was, approved tomorrow, that would not solve the extremely desperate cash flow situation of them only having $16 million worth of cash in the bank. So, all things considered, I think this is a very irrational or very difficult to explain share price movement that has just been pumped up by retail investors. And my personal opinion is, I wouldn't touch this stock with a 10-foot pole, because why would you pay $100 million for a company that is about to go bankrupt?
So with that being said, what about the other side? Like, if the company is if the share price has gone up by 10x since just a few weeks ago, and the company itself is saying it's probably going to go bankrupt before the end of the year, and they're like issuing new shares, so a short squeeze isn't really likely. Does that mean you should short it?
Well, I mean, maybe you could short it, but it might be difficult to find shares to borrow, and the cost to borrow might be prohibitive. Also, I mean, the thing is, this company is worthless. It's going to go to zero. So this is from their second quarter 10Q filing. They themselves says the company believes that the current cash on hand, $16 million, will not be sufficient to fund its current operating plan through the fourth quarter of 2023. So the company itself expects to go bankrupt uh, by the end of the year. So it's worth nothing. Now, if you back when it was at 6 cents, it was also worth nothing. And from like the perspective of a short seller, it doesn't matter if the stock is at 6 cents or at $600. If it goes to zero, either way, you've made a 100% return. So you probably could have made an argument for shorting the stock at 6 cents. Now, if you did that, you would have been in for a world of hurts. You probably would have got margin called here after the price increased almost tenfold. So at this point, the share price has been completely disconnected from the fundamental value. And another thing to consider is that even when a company declares bankruptcy, the stock does not immediately go to zero. Fundamentally, the stock becomes worthless because the equity holders no longer own the business, but the stock can still trade, and it can actually still go up. If you remember, there was a case a couple of years ago when the car rental company Hertz went bankrupt, and a lot of retail investors got really excited about it for some reason, and then the share price surged. This was a big story, I think, back in 20 yeah. So back in 2021, so Hertz went bankrupt and went back to and then got listed on the over-the-counter markets, and then the share price surged despite the fact that the company was bankrupt. So even if the company goes bankrupt, that doesn't mean the stock is immediately going to go to zero, and so you still have a lot of risk as a short seller. So I tend to try to avoid these types of situations because the movements of the stock are so disconnected from reality in the short term, and it can be so volatile in the short term that it's really hard to it's really hard to sleep at night if you have any position.
I feel like situations like these are like they're tempting, right? Especially when you see it was at 6 cents not too long ago and it's going to go bankrupt, and you feel like, oh, like the stock's going to go down. But when the stock price is so low, it might be different if the market cap was like 6 billion instead of like 100 million like it is now. But like right now, when it's so small, anything can happen to the stock price, right?
Yeah. And I think this is another, how there are statistics where, like retail investors tend to like underperform the market on average. And I think that is because retail investors try to get involved in these kind of crazy situations. And you see all this pumping on Twitter of these people, posting memes about this about to go bankrupt company. And people kind of get sucked into, when a company is like this, you're not investing if you're buying or selling the shares. It's a casino. It's like you're gambling because there is no fundamental value. The company themselves is telling you they're about to go bankrupt.
Yeah, and some people like that. Some people that's what they're going for when they get involved with these types of stocks. They just want the huge variance. It's almost like investing in options when it's just the equity. But if you actually want to make
Yeah.
money, it's probably not where you want to be.
Yeah. Well, I think that about wraps it up. Unless you have any final thoughts, and also we would love to hear the thoughts from all of you, the viewers, in the comment section. Is there something about the story with T2 Biosystems that we're missing? Is there some rational way to explain the recent share price action? Please let us know in the comment section below.